So credit card rewards are going to have a massive shakeup in the very near future because the RBA has proposed changes that could rewrite the rules for premium reward credit cards, and unfortunately they won't be in our favor. In this video, I'll break down exactly what the RBA is proposing to change, explain the impact of those changes, and then look at not only how they could rewrite credit card points and programs forever, but also the potential impact to everyday consumer prices and small businesses as well. And finally, I'll share what I'm personally doing about it, so let's dive straight into it. So the RBA is proposing two key changes that they are wanting to implement by 2026. Firstly, they are proposing to ban all card surcharges, and secondly, they are proposing to sharply reduce the credit card interchange fee from 0.8% down to 0.3%. Now, for the first change, this essentially means that retailers will no longer be able to add any additional fees if you decide to pay with your credit card. Right now, if you went to a local cafe and decided to buy a coffee, whilst the coffee might cost you $5, if you decided to use your credit card, you might end up paying $5.20 due to the additional surcharges. Now, interchange fees are essentially the fees that merchants end up paying issuers and payment networks so that they can actually accept credit card payments. Now, the RBA's argument as to why they want to impose these changes is because of kind of three key reasons. Firstly, eliminating card surcharges would simplify payment processes and boost fairness in how consumers are charged. This would result in Australians potentially saving approximately $1.2 billion per year, which is the total amount of surcharge fees being paid each year by Australians. And lastly, by removing surcharges, the RBA argues that it will increase competition by making payment providers and banks have clearer fee structures so that small businesses can make better comparisons. But are those reasons actually legitimate, and will consumers and businesses actually benefit from these changes? To explore that further, let's dive into the potential impacts of those changes. So let's first explore the impact of the reduction in the interchange fees. Now, currently, whenever a consumer uses their credit card, an interchange fee is being paid to the bank or payment network that issued the card. It's currently estimated that due to the proposed reduction in the interchange fee, card issuers and banks will see a nearly $800 to $900 million drop in revenue each year. Now, the banks will need to recoup that revenue from somewhere if they want to maintain the same level or even increase their revenue, which is oftentimes their goal. Critically, banks actually use much of their interchange revenue to actually subsidize credit card reward programs like bonus points, cashback, travel perks, interest-free days, etc. Higher tier cards like the American Express Platinum typically have higher associated interchange fees for this very reason. Thus, a logical conclusion for banks and card providers is that by cutting interchange revenue, they'll be forced to either recoup the shortfall from cardholders or to seriously cut benefits. For anyone who is currently holding a premium rewards card like a Qantas or Velocity co-branded frequent flyer card, we should be bracing for lower returns if these changes are passed, as these cards rely heavily on interchange revenue to fund its benefits. The likely impacts that we would see are that banks would likely reduce lower earn rate caps, essentially reducing the number of points they give out per dollar spent. They could also increase the annual fee and remove any non-point perks like lounge passes and travel insurance. We've actually already been seeing a lot of these changes already in the market. Westpac announced that they'll be reducing the ongoing earn rates and introduce limits across all of their credit cards. And we've seen non-point perks across multiple cards being removed as well. The RBA itself warned in its consultation that issuers could charge higher card fees or reduce the value of their card benefits or reward programs if interchange falls, and this isn't actually the first time the RBA has intervened and lowered the interchange cap. Back in 2017, the RBA lowered the interchange cap down to its current 0.8% cap, and banks almost immediately restructured rewards program. Back then, banks responded by slashing points on earn rates on many cards and imposing monthly or annual caps on the points earned. They also raised annual fees or reduced points transfer values to airlines to offset the loss margin. And in some cases, some banks actually exited from the credit card reward space entirely. Macquarie used to offer Qantas co-branded frequent flyer credit cards, but after the changes in 2017, they removed them completely, and these days they only offer credit cards that are linked to their own reward program that they have more control over. The RBA's proposals actually mirror reforms that we've seen overseas in Europe and the UK. The UK currently enforces a 0.3% cap on credit card interchange, and the EU has extensive fee caps and also implemented the no surcharge rule. As a result, credit card rewards have basically been drastically slashed as a result. The banks now in the UK mainly reserve points program credit cards for cards that have very high annual fees, and most everyday cards offer only modest earn rates or none at all. In practice, Australia could see its reward landscape begin to resemble the UK, with more limited earn rates on mainstream cards, with big sign-up bonuses only confined to very expensive premium products. Now, potentially the one silver lining to all of this is that the proposed changes to interchange fees won't impact American Express. This is because American Express operates its own payment network and as a result has always been able to set its own interchange fees, which have always historically been higher than Visa and MasterCard, which is why sometimes when you go to pay, surcharge fees with American Express are oftentimes higher. Now, this could give Amex a bigger competitive edge because its products could be more rewarding against its competitors, but American Express still has to convince merchants to actually accept payments with American Express. And as we'll discuss very shortly, if credit card surcharges are banned, then businesses may stop accepting American Express because they won't want to front the costs of the higher interchange fee. Which I guess segues nicely to the impact of banning credit card surcharges. Now, when it comes to the proposed changes, it essentially means that the costs will shift to the merchants themselves. Businesses can no longer pass card fees onto paying customers even at cost. Without that leeway, businesses, especially small ones, may have to raise their prices in general to recover card costs. I mean, think about it. If you're a cafe owner running on a 5% margin and you now have to absorb a 1% surcharge fee, that's essentially 20% of your profit gone. The food and beverage industry predicts that eliminating surcharges would ultimately end up driving up menu prices for pretty much everyone. The RBA calculated that consumers would save on average around $60 per person with no card surcharges, but some of those savings would be ultimately offset by higher retail prices. So consumers could actually end up being worse off instead. In my opinion, the banning of credit card surcharges only really redistributes costs. It's shifting the cost burden previously borne from card-using customers to all customers collectively. This means that if you are someone who never used credit cards before and relied solely on cash, you'll now actually probably be worse off due to the increase in prices. But without a surcharge penalty, those people who once didn't use credit cards before due to the surcharge may now opt to start using credit cards, which could potentially increase interchange-related revenue for banks and card providers, as there are now more users. Now, if you haven't already signed up to my weekly newsletter, then check it out below. I post weekly and provide my thoughts on updates just like the one we're talking about today, except I'm able to get those out a lot quicker to you guys rather than making a full video about it. So what am I doing about everything? Well, for the time being, I don't think there's really anything that we can do as these changes haven't actually been implemented yet. But if these changes are implemented next year, I think it's pretty much guaranteed that we'll see a significant impact to the rewards offered by credit cards. People who are within the credit card reward space, like me, will no longer be able to rely as heavily on sign-up bonuses and ongoing earn rates to accumulate as many frequent flyer points. I think there will need to be a shift towards other methods of earning frequent flyer points, like through retail reward programs, through Coles' flyby program, or Woolworths' everyday rewards program. Alternatively, we could look for other types of sign-up bonuses, like through switching electricity and gas providers or insurance policies as well. If the proposed changes are confirmed ahead of the 2026 date, personally, I'd also be trying to churn through as many cards as possible prior to that date. Let me know your thoughts on the proposed changes down below and what you're planning to do about it. If you found this video informative, then hit the like button down below and subscribe as well, because that's the best way to support me here on this channel. And if you're interested in why credit cards have been getting worse in 2025, then you might want to also check out this video right here. Hopefully I'll see you there. If not, thanks for watching as always.